welcome you into another edition of Scrushy on Business. My name is Dave Green. Richard Scrushy, as always, is alongside as we are nearing the heart of the holiday season. How are you, sir?
Man, I'm doing good. I'm really doing good. I tell you, I've had a busy week. I've traveled. Had my daughter graduated from college. My son-in-law graduated.
Congratulations.
Yeah, yeah. So we really enjoyed that. We had some graduation parties, and that was fun. And now she's home, and I'm excited to have her here, and looking forward to what God has got for her next. So, how you been? I know you've been busy as could be.
We are very, very busy. We just closed on a transaction today, the radio station that I told you about that we had purchased. So excited to have that finished before the end of the year, and now a lot of growing coming for that because it's these days you can't just air a radio station, right? You're a digital property and have to market it as such and sort of get people to change their habits, which is very difficult to do oftentimes, but we have more and more people, of course, that are, all about the phone, right? What everything is coming from the phone, whether it's streaming, audio, video, communication, obviously with one another through text and all the different social media. It's unbelievable how, we went from the giant screen, right? And then we all had to have the big screen at our house, but really we all, deal with something that is, this size.
Yeah, yeah, yeah. Now, how do they value? How do you currently value a radio station? I mean, is it's got to be value? Is it? It has something to do with the power, I'm sure, and the reach. So how
So
do you do that?
yeah, there's been a formula that's been used based on the number of people that the signal can reach in the market that you're in, but it is incredibly difficult these days. We were fortunate in this situation. There was really a property buy that was what
Mm.
95% of it was. So property and the equipment that came with it at the studios and the transmitter site, because it is difficult to put a value on a piece of paper. And that piece of paper is the license from the FCC, and you don't really need it, right? You don't need that license to broadcast. We're an example of that right this second. We don't have an FCC license to broadcast. We're recording this and it's going to go up on YouTube and as a podcast, and you can do it without the signal. So the values of those are coming down. What we're attempting to do is, local media has completely changed. I'm sure where you are in Houston, you've seen it on television, right? The television stations don't have nearly the crews that they used to have, the staff, the reporters are getting younger and younger. They're working for less, let's face it. Also, the people that you see on the news, they filmed that, they edited it, right? They got it ready to broadcast. It didn't used to be that way. So local media is really changed. And I'm a big believer in local media. So while everybody is trying to see how they can get, people from big cities like Houston to record and air in the rest of the country, right? We want to try and be super hyper local
But
and
what what's
be able to
what
talk about
programming?
it.
Are you playing music, or is it talk
Yeah,
radio?
talk.
It's talk. It's pretty much talk, isn't
I
it?
don't know how you can do a music station these days, right?
Yeah.
Because
Yeah.
again, I can pick my own music.
Yeah, that's true. You just don't, it just doesn't. So, back in the day, radio played a major role in whether or not a record was a hit.
Yes.
Song was a hit, radio play. And even back in the day when I was in the music business, and I actually had songs that played on the radio. And I remember that one of our songs went to number two on radio in a particular market, and we ended up going there and doing concerts. But it was driven by play, and that was it.
The
So how do
facts
they
are
do? I
this.
don't know how they do that now.
9 out of 10 people, right, used to be listening to the radio in their car. And the
Yeah.
truth of the matter is that 7 out of 10 people are still listening to the radio in their car. So
Mm.
it's both less than what it was, but it's still getting a heavy majority of, the listenership in car. But that's coming down as more people connect to their phone, connect to apps, or connect to YouTube. It's amazing to me how many people at work and in the car are connecting to programming through YouTube. They're not watching the video, obviously. They're hopefully they're just taking in the audio, but
Yeah, taking it in. Yeah, well, listening to the believe it or not, podcast. And I mean, that's what we hear. I have people tell me I listen to your podcast when I'm driving into work every day. Um, it's amazing. Things have changed, haven't they? I'm maybe a little bit old school, but I actually watch in the mornings the Houston television station and see the weather and listen to what's going on in the community, and then I flip over to one of the others. But I do catch that in the morning, and I enjoy watching and listening to what's going on in my community. But I think that's a lot less than what it used to be, huh?
it is,
On
and it's a
television.
shame.
Yeah.
But there are people that are out there that are doing it on their own, right? Doing it as a podcast in a community, or the truth is, we're to put it as simply as possible. We're not a radio station. We're a podcast network. It's people from St. Louis, in this case, doing podcasts about things happening in St. Louis. And so, that helps localize it. And the radio is just another way to reach audience. So
Way
it
to get it out there. Yeah. Yeah.
a lot has
Wow.
changed. A lot has changed. You've been watching a lot of things changing in big business. We started talking about
Yep.
this last week, about venture capital, and you continue to see some deals that make you maybe scratch your head a little bit.
Yeah, and I want to talk more about that. Maybe over the next couple of shows here, let's focus on that because we are, people are out there with ideas and concepts, and they want to know whether or not they qualify to be able to raise money, in the from the venture capital market, and let's just have maybe take a quick broad look at it. First of all, there are small cap venture capital firms, meaning that they're micro cap too. I mean, some things that are under 10 million, where you can raise 3 million or 5 million or 10 million. There are funds that actually do that, and there are a lot of them still out there. And then there's the ones that are over 10 million and up maybe as much as 100 million or 150 million. And then there's those that are 3 and 4 and 500 million and some that do billions of dollars. I was looking at, I had a real good relationship with a fund called New Enterprise Associates back in the day when I was just getting started. They invested in my company. I actually put money into the fund and I had investments in other investments that they made as a partner with them in the fund. But also, I got to know their leadership. I understood how they worked. I went to many meetings with them. I listened to the kind of deals they wanted. What were they looking for and what were they not looking for? What would they expect, out of a company but in order for them to invest? And I just really learned a great deal about the entire venture capital business and what people should expect when they are out there searching venture capital. And one thing they can expect, they're probably going to get turned down several times before they get funded, and
Yeah.
that's a fact. Uh, but also now things have changed a lot. But in the venture capital business, speed and scale, speed of building and growing and scale is actually a little more important than profitability. Profitability needs to be in there, but they want to know, they're not. If you're going to do something that's just going to be kind of lifestyle fun, and we're just going to enjoy doing this, and we're going to take our time about it, you don't need to go to a venture capitalist because they're not going to buy into that. They're
Right.
looking for huge returns, and they like 10 times. So, I mentioned before 5 to 6 times your money in 5 to 6 years. The more I study it now, because of AI, because of software companies, because of all the huge returns that these venture capitalists have got, they're kind of accustomed to getting 10 times their money, uh, and more often now than they were in the past. So, you got to be able to show that you're gonna be able to generate that kind of growth. So that's real important. A few things that you have to think about: are you willing to give up ownership? Because you got to give up ownership, and then they're going to want to be on your board. So you're going to have a board, and so you got to give up some control. Because now, when you hire somebody they're going to want to know, how do you determine what you pay them? And I actually, in the early days, once I brought on the venture capitalist into and had invested in our business, and they came on our board, I'd have to even go before them and say, this is what my raises are going to be this year. I want to hire this person. I want to pay them, this much money. And they would argue with me about that. And so I had to always have my gun loaded and be ready to present properly, why and justify everything before them. So what did that do? That made me better. Okay. And I didn't look at it as a negative, even though I didn't like it, but I saw it made me prepare and made me better. So those things are important. But when you are thinking about raising venture capital, what is it exactly that you're going to replace, improve, eliminate pain, provide a better alternative, a better opportunity? You got to be able to package whatever it is and justify that this is going to make this world better, and here's how it's going to do it. Uh, it's important, very important. So, what is the solution that you're bringing to the table, and then why now? Why is now a time to do that? And then here's another question: why you? Why are you the one that needs to do this?
That's going
What
to be a
makes
big
you?
question.
Yeah, what makes you? Why? I mean, why you? And who are you going to bring to help you? And what is their experience? So, you got to look at the found as a founder. If you're bringing this to the venture capital market, you're the founder. So why you, and why now, and how, and what is the problem that you're going to eliminate, or what is the opportunity that is out there, and then how, and then of course also, how, why, who are you bringing with you to help? Because you can't do everything by yourself. And so the people, they will want to know how you're going to scale it and how you're going to grow it, and what is the team. So and when you put your presentation together to go to the venture capital. I'm putting this information out there because I want people to think about it. Start with the problem. This is are the opportunity. This doesn't exist today, and here's what we're going to do. And here's what we're going to create, and here's how we're going to solve a problem or create an opportunity or make something much better. So you basically have the solution, and then you need to be thinking about, and they're going to ask you this: what is the market size? I mean, how big is this? Is this something that can be, is it just regional? Is it national? Is it international? Is 50% of the people in the country going to need this, or going to want it, or 20% or 30%? So you got to be able to talk about market size, and then you need to be able to discuss traction. How are you now going to go out and get traction with your product and what you're doing, and how's it going to work? And I had to go through this. Now, I invested in a lot of companies back in the day. I had several pharmaceutical companies I put money in. I put in money into numerous healthcare facilities, and they all had particular niches that they were growing in. And look, I had to go to the venture capitalist when I put money in some of those companies and help the CEO raise the venture capital. And kind of interesting thing, Dave. I remember one night I had a company that I had taken that was kind of a little different, a little different. It was actually a pharmaceutical company, but it was a little different than your traditional pharmaceutical company. They didn't have a patent or anything, but they had a drug that was out of patent, and they were going to manufacture it in a different format, in a different form. But it was a needed drug. And so I pitched it with this guy who was the founder and the CEO to multiple venture capitalists. We're in a meeting and we pitched the deal. And so I had dinner with those guys that night. So they said, we'll meet you at such and such restaurant, and we'll meet you at the bar, and then we'll have a little conversation, maybe have a cocktail, and then we'll go have dinner. So I get to the bar that night, and three venture capitalists are leaning on the bar having a cocktail. And they said, Richard, we have never invested in a company that was just like this. We've invested in pharmaceutical companies that had, products that they had created and they were new and yada, yada, yada. But what you've got here is a remake, and a different, you're just putting a different twist on the products that's out of patent. Those patents run out in about 17 years. And they said to me, they said, "Are you going to put money in it?" And I said, "Yeah." And they said, "Well, how much are you going to invest?" And I told them. And they said, "Okay." Right there that night at that bar, they said, "We'll put 3 million in." Well, the guy was only raising 3 million. So that was a done deal. But what I'm saying is skin in the game, the commitment, the fact that I believed in the CEO,
Yes.
felt like he had a good team. I believed in the product. And by the way, let me just tell you this, and as they built that company over about a 4 year period, and every one of those venture capitalists that put that money in there got huge returns because they sold it to a major pharmaceutical company, a national pharmaceutical company, about 4 years later. And so everybody made out. The CEO made millions. Everybody that put money in it made millions, and they were all very, very happy. So, anyways, just a little story of the fact that I was willing to put my own money behind that CEO and behind the concept. It went a long way. So, you got to look at growth rates. You get the traction, how we're going to grow, what is the size of the market, and then your team. And now, when you get your team together, and great slide is here's our go-to-market strategy. Go to market. In other words, here's my team. Here's what their qualifications are. Now, here's how we're going to launch this thing. And here's how we're going to go to market. And here's how we're going to grow it. And here's how we're going to scale it and all of this. And so, as you put that together, then the next thing that falls out is the financials because you've built this is how we're going to market, this is what the opportunity is, and this is how we're going to grow it. So then you can take, and if you know that every time you do one of these widget sales, you're going to get $100. Well, you've explained how many you can do a month, how many you can do a week, how many you can do a day, how many you're going to do a year. So you just back in, you create your financial pro forma, and you show them what kind of returns they're going to have over a period of time. And this is where it gets kind of queasy because the CEO will go, "Well, wait a minute, I know I can do this," and you calculate that out, and it looks like it's not going to give not going to give the investors a return that they're going to require. So now you got to come with a strategy. How am I going to get the return there? So I'm going to have to hire more people. I'm going to have to expand quicker. I'm going to have to make some changes. I'm going to have to keep my costs down. And so you begin to build the model. And why is that important? Because if you don't put this together right, and Dave, I've seen this. I've had seen the CEOs come in and not be able to answer all these questions, and they just turn them down.
Hmm.
Because if you can't, pitch it right and explain it and answer the questions, then they're not going to invest in you, and your business is not going to be able to get launched. So it's important. Now, another thing you have to do is clean up your structure. Dave, a lot of people may not start out in their business thinking they're going to have to go out and raise venture capital.
Right.
So they just kind of put it together, brothers and sisters and neighbors, and we got all this thing put together, and this is how we structured it. And it's an LLC or it's a limited partnership or whatnot. But anyways, bottom line is when you get ready to go to venture capital, if this thing is not really clean and structured appropriately, it's going to kill the deal. If it's got hair on it and it's not clean, I'm here to tell you, you're wasting your time. They're going to put you through the under the microscope. You want to have a nice clean, especially venture capital they're looking to take it public. If you structure everything as if you got to go before the SEC and you're going to take it public, it's all properly organized, then you've greased it. It's going to make it a lot easier. So, contracts, one of the things too that is real important, and I'm just going to throw these things out. There's so much that we could talk about, but I want to throw these things out. Consider investing in your employees that are going to be, that are key. I mean, and when I say investing them into some ownership. Now, venture capital is like that. They tend to like a 5 year, 3 to 5 year vesting period. So if you bring in a CFO, you bring in a chief operating officer, and you say, okay, I'm going to give each one of them 10% of the company or 5% of the company, but I'm going to give them 1% a year over the next 5 years till they get to 5% or 2% a year. So they get this, whatever that is, or X number of shares. It's going to be X number of shares over a certain period of time. Now, you do that for two reasons. Number one, It incentivizes them, and they consider themselves now part of the company and owners. And it shows that if they help you build this thing into a, $1 billion company, they're going to make a lot of money. But also, it tells the venture capitalists that that they're going to be there. You've basically got a chain on them now because they're not going to walk out without knowing that they're vesting. They're going to stay at least that 5 years. And then typically what happens is that they stay longer because now they're so committed. They own a nice piece of the company. They don't want to lose it. They don't want to see it go down in value. So they're going to work very, very hard to help grow that. And it eliminates turnover. And one of the things you don't want when you're out there as a venture capital backed company, or you're trying to get out there in the first 2 or 3 years where you're trying to get your traction and you're trying to build it and grow it. And that's a real stressful period of time. What you don't want is your key people leaving.
Right.
You got them tied into a vesting period, they're going to hang on. They got a reason to see it through. And so these are things that are very, very important. I don't care how small your business is. If you're opening a flower shop and you've got somebody in there that can make arrangements really good, give them a piece of equity and watch them perform. Let them know that, you're going to get 5% or you're going to get 10% of this company, and keep them there and tie them into the company so that they can get some upside. And, if you're greedy and you're at the top and you're not willing to share with your really loyal, hardworking people, you're probably not going to do so well. What do you think, Dave? I mean, do you see the same thing in your business?
Yes, no, absolutely. You have to have buy-in. We talked about before, how do you get the ownership mentality out of an employee? Well, the best way with really good long-term employees is to actually do it. Like Richard just said, give them that opportunity to earn that ownership. Ownership is something that a lot of people don't have the opportunity to ever have.
That's right. And so one of the things they're going to ask you for your cap table. That's the capitalization table, your cap table. And your cap table is going to have everybody's ownership, okay, and any money they put in. So they'll be able to look and see, okay, here's the cap table. Here's who owns this company. The CEO owns 70% or 60%, and these other people own 5 or 6 or 3 or 10%, whatever, 20%. And they're going to look at that. And so a good, clean cap table, and your cap table needs to make sense. In other words, you don't want somebody at a very, very low level having more than the guy that's the chief operating officer. I mean, people, it's got to, and if you can make it make sense in the way that you allocate out the ownership of the business, it's going to go a long way. And you need to have that, it's got to be laid out properly. You need to have clear roles as to who's doing what, and that needs to be easily seen. And then when you put your org chart, your organizational chart together, the authority levels are pretty clear. You can kind of see how it all flows and how it works, and all that has to be put together. And that's going to play a really good role also in your recruiting. When you start recruiting your leadership to run the company, they're going to want to understand what's the organization, how does it work. All that's got to make sense, and that'll go a long way as well. So it can't be sloppy. It's got to be well organized. You go in there with some kind of sloppy structure, and you're never gonna get funded. I can tell you that right now.
Oh
It's
yeah.
Yeah, it's
Oh
not
yeah.
going to happen. So you got to get all your metrics in order. You got to get, you got to be able to show your revenue, your growth rate, your margins. Explain how your customers are going to come in. And one of the things you'll hear, they'll ask you, "What's your burn rate?" What's your burn rate? All they ask you is how much money are you going to lose every month until you get this thing profitable. Now that's important. That's real important because if you don't know what your burn rate is, you're in trouble. You've got to know what your overhead is. So you got your revenue and you got your expenses. Okay. And if your expenses are a lot bigger than your revenue, you're going to have a burn rate.
You got problems
You
and a
got to
burn rate.
and you may have a burn rate for a year or two. So when you raise money, and for example, in this one company, they raised $3 million. They had a burn rate. They were losing money. They went out and they hired 80 salesmen to sell these pharmaceutical products that the company had. and until there was a point that as those 80 salesmen got out there and they start paying them, they're losing money first month, second month, third month. But then every month it got better and better and better. And by the end of the year, it was profitable. That sales were much larger than the burn rate and then the expenses, and you're making money. So that's really important. So your pitch deck has got to include all the things that we've talked about. It's got to flow very, very nicely. You got to make sure that all of these things are important. So you in your pitch deck, you're going to have your financial model. You're going to have your cap table in there, and any key contracts, customer references are also very, very important. You put those in there if you have those. If you have them, if you don't, and you're a startup and you plan to go somewhere, you need to explain who these are the people we're going to. We hadn't got them yet, but this is what we're working, and these are the people that we're pitching to. So there are a lot of things that you want to make sure you have in there, and don't get your feelings hurt when you go to the first venture capital meeting and they tell you we're not interested in this right now, or we're not going to do this, and because let me tell you, you may learn. They may tell you these are the things that why we don't invest in you. And these are the things you got to change. You may have to go back out, restructure, make your presentation better. Uh, Hire whoever they may tell you, come back when you have somebody with this experience or that experience. I don't know. I mean, it could be a dozen different things they're going to tell you, and then you may have to go out and find somebody else. But I will tell you this, and here's the good news. And we're talking about all of this. There are a lot of funds. So I started studying all the funds out there, just kind of digging up to see how many were small cap, how many companies are out there right now that are investing in, two and three and four and $5 million transactions. And there are a lot of them. And there are companies, and I mentioned the New Enterprise Associates. I noticed that New Enterprise Associates, and I got to share this with you. Let me see if I can find it because I pulled it up to look. Um, they invested in this company, Clio, that legal AI software
Oh yeah.
company. The valuation was 5 billion, 5 billion. And New Health, this accountable care organization, and I'm not really sure how they pronounce that. It's spelled NEUE Health. That was a 1.465, 1 billion, $1,465 million valuation. And they invested in this Wonder Cloud kitchen. You familiar with that company?
I'm not.
Yeah, I think we actually had some conversations with those folks, but they consider themselves the Amazon of food. They bought Grubhub. They had a
Okay.
600 million dollar round, I think, with a $7 billion valuation, and NEA was involved in these. So NEA did more than 65 investments in 2025. It's incredible, isn't it?
Yeah.
I mean, that's a lot of business right there, a lot of investments. So they've invested in a lot of different companies. But as I was looking, I mean, here was a company they invested 7 million in. So here you got one. They were in a $600 million round. They were in a $5 billion valuation. But here's a company they just put 7 million in. So as you, deal size was 7 million. So they do a wide range of investments, and I don't remember exactly how much they put, but they put several million in our company. I think they invested in two rounds. And I'm looking here. Here's a $55 million deal, an $18 million deal. So, that's pretty wide range of investments that they make. But as you study and you research on the internet, and you can find that there are funds to fit every size, Dave. Whether you're trying to raise $1 billion or whether you're trying to raise, 10 million or 2 million or 1 million, there are people out there. Angel investors typically will get you in the low end of that, maybe a million, maybe half a million, maybe 2 million, 3 million. But there are venture capital firms out there that are looking for deals, and I like those deals myself. I like finding entrepreneurs that have concepts. Now, you keep in mind too that we founded Health South with the original venture capital investment was 1 million, and then we did two more rounds. I think 5 or 6 million on each round, and we built it into a multi-billion-dollar company. So And that was all the venture capital we had to raise, and then we were able to take the company public. So um, you can take just a small company can become a multi-billion-dollar company. I mean, it's just a reality, and it depends
You've
on the.
proven that more than once.
Yeah, yeah. I mean, that's what I'm saying. You know, we took Med Partners, became Caremark. Caremark became a multi-billion-dollar deal. CVS bought it. I mean, we put 3 million in Caremark. That's how we founded that company. We only put 3 million in it, and in that company as well, just like that pharmaceutical company. And it sold for over $20 billion. I think it was 21 or $22 billion uh, to CVS, and it's out there today. When you see Caremark CVS, that was the
Yep.
company that Larry House and I put the original money in, founded that company, and did quite well. So uh,
We
I
have a
don't know.
question I want
Yeah,
to ask
go
you
ahead.
that
Yeah,
came in from Mark in San Francisco, and you've kind of just answered it a little bit, but I want to ask you if this is totally about money, really. He says, I hear founders talk about venture capital all the time. What do most people misunderstand about VC before they ever try to raise it? And I think you just kind of answered that, right? That there are funds available at a very wide range of numbers.
there is. Um, but I guess I went to I have my son-in-law went to West Point, and I had an opportunity to go visit him, visit West Point, and go see where he went to, and all the things and the regiment and all the stuff that they went through, and going into the room, and I'm using this as an example. The clothes have got to be, everything's got to be folded a certain way, the bed, everything's got to be perfect. When you go into venture capitalist, you're not going in there to say, hey guys, good to see all y'all. Let me tell you what I'm thinking about doing. No, you got to be just like those cadets. Everything you go in there and thank you for allowing me to come in and present to you my company. We're very excited about what we're able to do. And you better lay it out, and it better be just like I just talked about. Okay. You just need to go, because let me tell you, they love ripping you apart. Matter of fact, the young guys, the young MBAs they bring all these people into the room. They're like alligators coming at you, and they do it and to impress the senior guys. And then the senior guys have got to say something intelligent and ask you some questions in order to maintain the respect from the younger
Of
guy.
course, of
So,
course.
I mean, you may go in there and just get your brain beat out and you feel like they have just ripped me to shreds, even though you're well organized. But it may be that you answered all the questions right, and they call you the next day and say, we loved it and we want to put money in your business. Or they may tell you before you even leave.
Right.
And then again, if you're not well organized, they'll eat your lunch. So it's not I think it's not one of these deals where, okay, we're going to go in there and just talk to them. You do not waste their time. You better have it. Do not go to a meeting unless you are 100% ready. And that presentation you're going to make, you need to have made it several times to other people and ask them to be real critical. And I like making it to an accountant, or making it to your banker, or making it to somebody else that has built a company or run a company, and find out everything. So the mistake people make is not being properly prepared and not realizing how serious it is and how valuable those investors that are managing $1 billion or more. I mean, NEA, $28 billion. You're not going to waste that guy's time. Waste his time, you're done. You're out of here. You be prepared. And you know what that is, Dave? That's respect. You got to respect somebody that's built a $28 billion business. And when you go before them, and have being prepared is a way to show respect. So
Yeah, do you have a story of someone who just came in and tried to pitch you, and you literally just had to cut them off and say this is
I've had more of those than I've had of the other. I can tell you, I've sat in so many of those, and I'd sit there for about 10 minutes, 15 minutes, and I would size up the person, and I would say, I no way, and no way.
and,
First of all, I don't believe anything you say or she
right.
say.
That's
And
just it, right? The
yeah,
okay, here's so Ashley in Dallas sent this question in, and I think this goes right to that. When a VC looks at a company, what actually matters most? The idea, the numbers, or the people running it? First thought is to say, well, D, all of the above. But You, you, the person who is pitching this idea, has to win them over quickly.
Tell us, it's that first what, who wrote the book? Somebody wrote a book,
Right.
first 7 seconds or first 8 seconds. That is it. You want them to be, look, if you don't catch them in that first 7 or 8 seconds, they probably won't pay any attention to anything you say. So yeah, you are important in the way you present yourself, the way you look, and believe it or not, even the clothes you wear. You got to go in and look organized. Don't go in there with a jacket that doesn't match the pants. I'm telling you, or a shirt that's got too busy, like a shirt I've got on now. If I am presenting to an investor, I have a white shirt on, okay, and I'm wearing a dark suit, and I'm wearing probably a red tie or a maroon tie or something like that, and I'm going to look sharp. Man, my hair is going to be combed. My shoes are going to be shined, and when I walk in there, I don't want. Let me tell you, they'll look at your shoes and go, "He doesn't even shine his shoes."
I have had that happen.
Yeah, you
Not
don't.
not in the negative, but I had someone who said to me, he said, one of the things I decided why I liked you. I said, why? I said, your shoes are shined.
Mhm.
I, I was like, I
I'm telling you,
didn't
it's
even
it's
think about it. I just did.
It's
It to
it's important, and you need to be shaven. You need, I mean, men need to shave. Ladies, have your hair fixed, and don't wear too much jewelry. You got to play that right. I had a gold Rolex. I took it off. I didn't go in the meeting with it on. I wore another watch, and I don't have a gold Rolex now, but I did back in the day, and when they were cool, and I thought it was cool. But I don't, there are things you don't do. You just don't do when you go in there, and it depends on who you're talking to. And I mean, you can get away with some things with some people, but assume
you
that you're not going to get away with it.
That's what I was going to say. Assume that the person you're going into is going to be, for lack of a better term, a ball buster, and is going to judge every single thing that you do. Now, maybe it turns out that you get someone who's relaxed and let them show that. But I hired a lot of salespeople and still do,
Mhm.
and I always tell them, buddy, I decided if I was hiring you the first minute you walked in, because
Exactly. That's what I'm saying.
that's how one of my customers needs to feel when you walk in. So, did you have presence, right? Did you do the little things, the handshake, right? Whatever it may be, I would decide that. And the rest of the other 29 minutes of the meeting didn't really need to happen.
How about the way you sit? How about the way you shake hands? How about the way you face the audience? How about everything you do? I mean, I've had people I was interviewing come back and lean back in the chair and cross their legs and look up at me and pull their glasses down like that, and I'm like, there ain't no way that I'm going to deal with you every day in my
Yeah,
life. My
doesn't
life's
work
too
that way.
short, and I'm too busy.
Yeah.
And I mean, I have to go back to the guy that I was interviewing, and he said, "Hey, I'm looking for something easy, something in management." And I said, "What? Something easy, something in management? Man, you got to be kidding me." That's where it gets hard. Management is tough. That's where you carry the load, That's where you're accountable for everything. But anyway, some people don't get it. But yeah, I think the numbers are the idea. If you make the right impression and you can get to the concept, and they don't throw you out, and they say, okay, so tell me about your business. You say, we're here, we're building this company, and you know here's what we do, and here's why we do it, and this is a huge opportunity nationwide or internationally, and because look, 50% of the people in America have to have this, and no one else has built one like us, and we can build this thing efficiently, and we have a and grow this into a very sizable company. And here's why. And these are the things that are important. And bam, bam, bam. And present it the way that it needs to be presented. Have your act together, and then say, "Do you mind if I give you? I've got a presentation. I'd like to show it to you, yeah, if you don't mind." And they'd say, "Yeah, sure, go ahead." And so if you get a chance to do a PowerPoint, or you got your computer and you can turn it around, and you start with the problem, you show them, we go right through the list of things that we talked about. Here's the team, here's the market, here's the opportunity, and then you build all of that. And here's the growth, and here's how we can scale it. And then let me show you how the numbers work. And here, tie the numbers right to it. And this is what we want to do. And here's kind of what our burn rate's going to be year one. And so we're trying to raise X amount of dollars because that will get us over the hump. And we can build it and you go through all of that. Now I don't want to go through a whole presentation here, but you got to go in with confidence. You got to look good, you got to act good, and you got to know your business. So what's the next question here?
The next question we have is from Laura in Atlanta. She asks, besides valuation, what parts of a term sheet should founders pay the closest attention to before signing anything?
Well, you're going to have to look at the control and how much, they're going to want board positions. And one of the things that I always did, I didn't try to take control. In some cases, they'll say, well, give me a Mexican standoff. You put three people on and we put three people on, and then we got six. And then that way, but if they come in and they say, I want five, and there's going to be six, and it's going to be you, and we're going to pick five, you got to negotiate that down because that's not going to work. You're not going to like that. So, if once they make a decision and you can tell that they want to put their money in it, then that gives you a little bit of an edge on being able to negotiate a better term sheet. So they're going to want, like I said, piggyback rights. If you have to raise more money, they may want to put an anti-dilution provision in there. You want to be very, very careful that you don't enter into that if you can get them out of it. I mean, you may have to do it to get the money, but you want to make sure you get enough money if you're going to do that. And what that means is if you have to do another round and you have to go out and bring in another venture capitalist, and let's say they bought 30% of your company, and they said we've got an anti-dilution in as part of the agreement. What happens then if you go out and raise another substantial round of capital, and those people come in and buy 30%. Now you're at 40%. And, because you couldn't dilute those guys, they keep the 30. So it begins to change all the numbers. So it really is very, very hard if they have an anti-dilution uh, uh, as part of the agreement, a clause in there. So there are things like that you want to look at. You want to look at the board size up. You want to look at the valuation. You want to make sure that they're not ripping you off on the valuation. And typically, on a private basis, I talked about this the other day, 3 to 6 times whatever your earnings are. Now, if you don't have any earnings and you got a burn rate, then you're going to have to come about the valuation some other way. And a lot of times, what companies do, they look at a trajectory over 3 years and say, okay, so here's how we want to value it. Keep in mind that most of the time, when you're valuing an investment, you're valuing it over. You're not looking so much in the past as you are in the future.
Future, yes.
You're looking for so when you're trading as a public company on the New York Stock Exchange, the Nasdaq, or the American, you're trading off of your next year projections. You're not trading off of what you've done. Now, why is how do you, and think about this? Here's how you know that's true. If you were trading on the past, then you wouldn't have the fluctuation as you change your future earnings. So when a company says, okay, we're going to earn $1 a share next year, and you're trading at 15 times earnings, so your stock price is $15, and you then change that and say, well, we're only going to earn 50 cents. Well, your stock price now is going to go down based on that. But if it's trading off of what you did in the past, then it's a different deal because you've already accomplished that. So when you are looking at raising money, it's the same thing. You're going to show them that, over the next 3 years, this is what we're going to earn. Here's how big we are. This is the growth. And they're either going to price it off of revenue. They're going to say we're going to pay 1 times revenue. We're going to value it at 1 times, 2 times, 3 times revenue, or we're going to focus on. And if you are a profitable company, they can put some kind of multiple on those earnings. So you got to look at how they structure that, and go from there. And then really, you just want to make sure that you as a CEO are covered in there, and they can't fire you. It was your idea, it was your concept, so you want to have some kind of agreement that they're going to support you and work with you, and that you've got some level of authority. And sometimes you go ahead and negotiate what that level of authority is, and it might be that you can spend $100,000, on a piece of equipment, or hire all employees under 100,000 or whatever. But at some level, you're going to have to get their approval at the board level. So, and then you talk about even future board. Who if one of the board members leaves, then how are you going to decide who comes on? Are they going to, what votes are they going to have? What votes are you going to have? So there's a lot of stuff in that agreement that you'll want to work through to make sure it's fair. Um, and my history and my experience is that most of the venture capital deals that I did and I was involved in were fairly fair. I mean, we had some things we had to negotiate on occasion, but it wasn't really that bad. And most of them had good attorneys. You want to have a good, remember, I talked about this too, Dave. You want to have an SEC attorney. You want an SEC attorney, somebody that knows how to structure a venture capital deal, and that'll keep you out of trouble. Also, you'll make sure that everything you do is additive to your ability to take the company public down the road. So you want to do all the right things. So you need a good accountant, good accounting firm, and you need good legal advice.
Great advice as always from Richard Scrushy. You can always write in info at scrushyonbusiness.com to get questions answered about your current business or potentially one that you're thinking about. And of course, we'll continue to give these types of insights as we go. We're going to continue this same topic next week in our show because we have several questions that we still want to get to, and we'll continue. Richard will to give you some of the information of VC deals that are happening and things that are going on that have closed. But Richard will close out this edition of Scrushy on Business, and I'll let you have the final word.
Yeah, I enjoy talking about these things. I know that we have a lot of listeners out there that may be thinking, how am I going? I want to build this business. How am I going to raise the money? Where am I going to go? Here's the good news: there's a lot of money out there. And if you structure your deal right, put it all together right, and you can find the market. They're out there. You can find the companies, the people, because look, they have the money. They're interested in putting money in good companies with good founders, good people, with good concepts, with leadership skills. They want to build companies. So, you got to, they're can do. And so if you can structure everything and put it together right, there's a chance that you too can build $1 billion company. And that's what I want to leave you with today.
That is a great spot to end it. Richard, have a great week, and we will see everybody next week for a new episode of Scrushy on Business.